Hey, everybody. A lot of people have asked my thoughts on a company called Medical Properties Trust. It's a REIT, a real estate investment trust. It's getting a surprising amount of attention over the past, what do you say, year or so. And the main reason it's been getting a lot of attention is because its dividend yield was very, very high. Still is very, very high. Um, but that's not always as good as it sounds. Before we dive in, Tyler is joining me today. Please take a minute and check out the link you see on your screen, fool.com/Frankel. You can get the top 10 stocks to buy right now from the Motley Fool. Best way to support this work we're doing on YouTube. Again, that is fool.com/Frankel. So, Medical Properties Trust, ticker symbol is MPW. And as the name implies, they are a real estate investment trust that invests in healthcare properties, particularly hospital properties. They have a presence in the U.S., the U.K., some parts of Europe. They have some Latin America. They have facilities in Colombia. 436 properties in the portfolio now. That number is going down. They're selling a lot of them. In the first quarter, they executed $1.6 billion in transactions. The short version of what's been going on with Medical Properties Trust is it's a high yielding company because its leverage is way too high. Um, they've already done a couple of dividend cuts. I think two, to my knowledge, but I might be wrong on that. At the current price, their current dividend that they just declared translates to a yield of about 12% at the current stock price. So, not a surprise that investors might be attracted to that. Now, I don't like to use the word dividend trap, lightly, but this might be one. Just to look at some of these numbers, the company has $17 billion dollars roughly in total assets, $3 billion market cap, $10 billion in debt. That's after reducing it by $1.6 billion in the most recent quarter. Um, it is profitable on an FFO, funds from operations basis. In the first quarter, it generated enough FFO to pay its dividend. But my question to you, Tyler, and you can talk about what's going on with their tenant too, is are they going to have enough to pay it in the future? That's the big question. So what do you think?
Yeah, the thing that they left out of the quarterly earnings report was the large sucking sound that came from the bankruptcy of one of its largest customers, which was Steward Healthcare. They were an operator of hospitals. They own some. They actually own quite a few, but several of its hospitals were, they leased from Medical Properties Trust. And the reason that I mention it is basically the day that Medical Properties Trust issued its first quarter earnings release, Steward announced Chapter 11 bankruptcy and had an intention to sell off 31 of its hospitals to pay off its own debt burden of about $9.9 billion. Now, the reason that this is particularly jarring for medical properties is because Steward was a significant tenant. And also there was a lot of we'll call them basically like side deals that Medical Properties Trust had invested in Steward on top of its regular leases. It had about $3.3 billion invested in terms of, per properties that it purchased from Steward over time. On top of that, it had about $500 million of long-term investments, which was an investment loan and a passive equity stake in Steward. So you had multiple tranches of investment in the business. And then on top of that, there was some transaction specific working capital loans of about another $250 million that were all just kind of all sitting out there. So we're talking about 3.3 half and then another two. We're talking about 4.2, $4.1 billion of those assets that you talked about that are in deep distress. And some of them we can reasonably assume go to zero. Like if you make an equity investment in a company that goes back, files Chapter 11 bankruptcy, that's probably a zero. And so there's a good chance that, some of the stuff that Medical Properties Trust was invested in Steward will go to zero, and that's going away. obviously the properties, they still hold onto them, but as Stewart had mentioned, they're trying to sell off a lot of properties, and perhaps some of it's just operated properties, not its owned ones. And when you do that, there's going to be a transition period, and there's a possibility that, we might not get rents for some of them while they're in sale or while things are being held up at bankruptcy court, because, you know, operating leases do get renegotiated sometimes. They're one of the least renegotiated things in bankruptcy proceedings, but they can be renegotiated from time to time. So it's something to consider. And so when you see this 10 or 11 or 12, I think at as we speak right now, it has a 11.8% dividend yield. The market is saying, like, even after this recent dividend cut, it's going to get cut again. And, there's, if you squint hard enough and you kind of like, rake yourself over the balance sheet, you're like, but man, it's trading for 0.4 times book value and it's got this huge dividend yield. Like, it can't get any worse from here. But one of the things that you'll learn, people learn in like turnaround investments, if you are somebody who wants to invest in turnarounds, it can get worse. It typically does get worse when you're investing in a turnaround before the turnaround actually happens. Sometimes you're trying to get into it early, but this has kind of been the sign that, that a lot of people who have been bearish on medical properties trust have said, look, if this goes sideways with the Steward deal, medical property is going to be in big trouble. And we just saw Steward go sideways. And because of that, it would be very, uh, I think it would be, you'd be very, very ambitious and perhaps taking on a little bit more risk than necessary, looking at medical properties trust today and being like, it can't get any worse, right?
Yeah, it can. The, the big thing, I don't know how many assets they're going to end up having to sell to bring their debt to a reasonable level. And that's a fluid requirement when you have tenants going bankrupt, right? Like if I tell you that, okay, I'm going to need to get rid of 50% of my debt and my financial situation is going to be stabilized. But if, half of my rental properties end up going vacant because the tenants are bankrupt, that requirement becomes different. Now you have a bunch of other like moving parts. Um, and I like turnarounds that have a lot of visibility. Uh, this doesn't feel like one of them. Um, I love investing in turnarounds. It's some of my better investments of all time have come from turnarounds. But like I said, I like turnarounds when you have a lot of visibility and predictability and a clear plan. You can give me all the clear debt reduction plans you want. When your biggest tenant files bankruptcy, they're the biggest tenant, by the way. When your biggest tenant files bankruptcy, and you have all these other little side investments with them, like you were just discussing, it's not a lot of visibility into the turnaround story. I've learned my lesson the hard way on that with a few REITs when they're trying to turn around the business. So for me, this is a stay away. Now, it's entirely possible that this is going to be a solid performer over the next decade if they can execute. I would not bet on that. I would bet on things like you said getting a lot worse before they get better. I don't think this will be a high yield stock for that much longer, and I don't think you're going to see it in my portfolio anytime soon. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment, so I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 4 times, so go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 650% as of April 16th, 2024, and are measured against the S&P 500 returns of 148% as of April 16th, 2024.